Welcome to AOF Market Intelligence, powered by AI. Look, it's no secret there's a lot of fear and anxiety floating around for Canadian real estate investors right now, across Canada, really. A lot of you are looking for some peace of mind, some stability in a pretty uncertain market. So today we're doing a deep dive into why Canadian investors are increasingly looking at Edmonton, specifically for multifamily rental properties.
That's exactly right. If your focus has been on those, let's say, high velocity, high volatility markets like Toronto or Vancouver, Edmonton's different. It really stands out. We see it emerging as this uniquely stable, kind of counter-cyclical place to invest. It offers a really compelling case, especially if you're prioritizing, capital preservation and steady returns over quick flips. So today we'll unpack a few key things. Edmonton's strong demographics, its surprisingly resilient rental market, it's a diversifying economy, which is huge for future-proofing, and some really powerful financing tools that can actually help de-risk your investments.
Right. Our goal here is to cut through the noise, find those nuggets of knowledge that explain why Edmonton makes such a strong argument for long-term stability and consistent returns, especially when, let's face it, the national picture feels a bit shaky. And to really get why Edmonton has this edge, we need to start with the basics, right? Which in real estate almost always means people. Edmonton's population growth is, well, it's a big driver. The metro area population is sitting at about 1,589,000 as of this year, 2025. And what really catches the eye is the growth rate, a strong 1.34% increase just from 2024.
Yeah, and the story behind that number is what makes it so solid for rental demand. It's about why people are coming. See, unlike some other big Canadian cities, the main engine here isn't international immigration right now. That's actually slowing down nationally because of federal policy tweaks. No, in Edmonton, the big driver is net interprovincial migration, people moving from other provinces. In fact, Alberta led the whole country in Q1 2025 with a net gain of over 7,000 people from other parts of Canada. And get this, nearly 1,900 of those came net from BC to Alberta in just that one quarter. Q1 2025 alone.
Wow, okay, so that's a significant point. How does relying on Canadians moving within Canada rather than international arrivals change things? Does it make Edmonton's housing demand fundamentally less vulnerable to those federal policy shifts we're seeing?
It absolutely does. It insulates it to a degree. Because the demand is driven by Canadians looking for affordability, looking for opportunity, moving away from higher cost provinces. Well, that demand is just less tied to federal immigration targets. It acts almost like a counter-cyclical buffer. You get this steady stream of domestic renters moving in, regardless of what's happening with broader immigration policy. It creates a really robust foundation for rental demand that isn't quite as volatile as in some other places.
Okay, that makes sense. But this influx of people, it naturally leads to questions about the job market. Some people might see Edmonton's forecast unemployment rate for 2025 around 7.7% and think, uh-oh, red flag? Is that the right way to read it?
That's a really critical question. And just looking at the headline numbers is misleading. You have to look deeper. That 7.7% isn't really a sign of economic weakness in this context. It's actually a direct result of the labor force expanding rapidly. More people are moving in and starting to look for work. That pushes the rate up temporarily. But look at employment growth. It's forecast to grow 1.7% in 2025. That's a big jump from only 0.5% growth in 2024.
Oh, bigger.
So there's this temporary mismatch, right? Population surges, jobs take a little time to catch up or be created.
Right.
But these new people need housing now, and they will find jobs eventually, which solidifies that long-term housing demand for multifamily properties. It's actually a positive indicator in a way.
Got it. So strong demographic inflow driven by Canadians seeking affordability. What about the rental market they're finding? Especially when nationally the headlines aren't exactly glowing. We're hearing things like rents in Canada fall for 11th straight month back in August. The national average asking rent was down, 2.3% year over year to around $2,137. How does Edmonton stack up?
Yeah, Edmonton really tells a different story, a much more stable one. While the national average asking rent actually dipped 0.7% year over year back in April 2025, Edmonton saw a positive 0.4% year over year change. The average rent there was about $1,628. Now, full disclosure, other reports do show maybe a slight 1% decrease year over year more recently, like in July, down to maybe $1,565.
Okay.
But we see that not as a weakness, but more as a temporary rebalancing. And it happened right after a truly historic surge in new supply hitting the market.
And that surge was massive, wasn't it? We're talking nearly a 60% year-over-year jump in multifamily completions in 2024. For any market to swallow that much new supply with rents staying relatively stable, That says a lot about the underlying demand, doesn't it? It's pretty remarkable.
It really is. And a huge part of that resilience comes down to affordability. That 1,628 average rent back in April, it's way below the national average of over $2,100. That makes Edmonton incredibly attractive. It keeps demand strong. Even when new buildings open up, people can actually afford to live there.
That definitely helps absorption. But investors always get a bit nervous about vacancy rates. Nationally, we saw about 4.1% in Q2 2025. Edmonton was a bit higher, 4.6%. How should we interpret that? Is it just noise from the supply surge or something more?
That's where the nuance is crucial. Yes, the vacancy rate did tick up slightly, about 0.7% by Q1 2025. But remember, that was despite that massive 60% flood of new units hitting the market in 2024.
Right.
So seeing only a minor bump in vacancy under those conditions, it actually shows incredible absorption capacity. It proves the market's underlying strength. It's a direct and, we believe, temporary consequence of that historic supply wave being digested. It's not a sign of fundamental weakness. And the key thing to watch now is that multifamily completions are projected to slow down in 2025.
Oh, okay.
That slowdown will give the market more breathing room to absorb the existing supply. So we expect vacancy rates to stabilize, maybe even start to decline a bit. It looks like a healthy market adapting, really.
That definitely paints a picture of resilience, not weakness, like the market bending but not breaking under that supply pressure. Okay, let's shift gears a bit. Let's talk about Edmonton's economy. It feels like it's really changing, moving beyond just being an energy town.
Oh, absolutely. There's a real transformation happening. One big piece is the rise of Edmonton as a serious AI and tech hub. And this isn't just aspirational talk. The city's getting recognized for its universities, its research institutions, and there's real government support behind it. The problem has this ambitious strategy aiming to attract something like $100 billion in private investment just for data centers over the next 5 years.
100 billion. That's a massive number. Can you give us a concrete example of what that looks like on the ground? And why Edmonton? What's the specific draw for something like AI data centers?
Sure. There's a proposed AI data center industrial park planned for northern Alberta. The scale is huge, potentially the world's largest. That alone could create somewhere between 3,000 and 5,000 long-term jobs.
Wow.
As for why Edmonton, it has some unique structural advantages. A cooler climate, which is a huge plus for keeping servers cool. That's a major operating cost. And it has abundant, affordable natural gas for reliable power. These are just trends. They're fundamental advantages. And you can see the momentum already. Edmonton jumped 11 spots, up to 38th on a list tracking North American tech talent growth. So it's happening.
Okay, so tech is definitely a growing piece. But it sounds like the economic story is broader than just that, right?
Yeah.
Offering more stability.
Exactly. It's not just tech. Edmonton benefits from much broader economic and, importantly, public sector stability. The economy is diversifying into healthcare, education, advanced manufacturing, sectors that provide a really wide, stable employment base. Less vulnerable to those global commodity swings,
Right.
And don't forget, it's the provincial capital. That means a large public sector presence, which acts as a significant buffer against economic downturns. It provides incredible stability. We're seeing forecasts for solid GDP growth, too, 1.6% in 2025, picking up to 2.5% in 2026. So you put all that together, tech growth, diverse industries, public sector stability, it creates a lower risk environment. That really translates into peace of mind for investors.
Okay, that economic diversification and stability is key for long-term confidence. Now, for investors actively trying to manage risk, especially in this climate, there's a specific tool that keeps coming up, CMHC MLI Select. Can you break that down for us? How is it changing the game for multifamily investors, particularly in a market like Edmonton?
Yes, MLI Select. It really is potentially transformative. It's a government-backed mortgage loan insurance program from CMHC. And it's designed specifically to encourage multi-unit rental properties that meet certain goals around affordability, energy efficiency, and accessibility. What it offers investors is pretty unprecedented financial flexibility. We're talking potential for 95% loan-to-value, or LTV. Think about that, only 5% down potentially.
Yeah.
Plus, amortization periods up to 50 years, 50. And significantly lower insurance premiums.
50 years, wow.
It works on a points system. So if you make certain commitments like keeping, say, 25% of your units affordable, defined as rent being 30% or less of the median renter income, or maybe you build or retrofit to be 40% more energy efficient than the building code standards,
Yeah.
those kinds of commitments earn you points. Rack up enough points, and you unlock those maximum benefits, the high LTV, the super long amortization.
Okay, 95% LTV and 50-year amortization sounds almost too good to be true. What's the catch? Is this something any investor can just jump into? Who really benefits the most?
That's a fair question. It's incredibly appealing, but it's not quite for everyone. It's definitely best leveraged by investors who are already well capitalized. CMHC has requirements. You generally need a net worth of at least 25% of the property's value and liquid assets around 10% of the value. So there are hurdles.
Okay, so it's for established players mainly.
Generally, yes. But for those qualified investors, the benefits are extraordinary. Think about the capital efficiency. Getting 95% financing frees up so much capital, and that 50-year amortization drastically lowers your monthly debt payments, which massively improves cash flow. It allows you to potentially recycle capital into new projects faster, grow your portfolio while having this incredible safety net. It really provides profound financial security, that peace of mind we talked about.
Right, that makes sense. So bringing it back specifically to Edmonton, why is MLI Select particularly effective here? What's the synergy with the local market conditions we've discussed?
This is where it clicks perfectly. The program's main goal is boosting affordability. And Edmonton's market conditions. Relatively low property values, relatively low rents compared to the big guys like Toronto or Vancouver. That makes it much easier to actually meet those affordability targets required by MLI Select without killing your investment return. Trying to keep rents below 30% of median income in Vancouver, that can be really tough, maybe even impossible for a viable project. But in Edmonton, because overall rents and values are lower, hitting those targets is far more feasible. It's less restrictive. So investors in Edmonton can more easily achieve a high point score, unlock those top-tier benefits like 95% LTV and the 50-year amortization. The program and the market fundamentals work hand in hand. It's almost tailor-made for a market like this.
That really clarifies the advantage. Okay, so wrapping this all up, what does this mean for you, our listeners, especially if you're feeling that market anxiety and looking for stability? We've covered a lot: the population shifts, the resilient rents despite supply surges, the diversifying economy, these powerful financing tools. It really paints Edmonton as, well, fundamentally stable. A uniquely appealing investment proposition right now. It's that blend, isn't it? Demographics, rentals, economy.
Exactly, and that CMHC MLI Select piece just adds another layer. It reinforces that this strategy in Edmonton isn't about chasing rapid speculative gains. It's a tool, a powerful instrument, that when combined with Edmonton's solid market fundamentals, provides a critical layer of financial security. It really speaks to long-term capital preservation and consistent yield. And for many investors right now, that's exactly what they're seeking, that genuine peace of mind.
So for those of you listening and considering your options, maybe a few actionable takeaways from today's deep dive. First, maybe target properties where you see that CMHC MLI Select potential. That could be older, well-located buildings ripe for renovation to meet affordability or efficiency goals, or even new builds designed specifically to hit those point thresholds. Second, really lean into the long-term capital preservation mindset. Leverage that potential 50-year amortization. It's a powerful tool to insulate yourself from market swings and interest rate hikes. Stability over short-term pops. And third, this is crucial: leverage local expertise. Don't try to go it alone. The MLI Select application has nuances, and understanding Edmonton's specific submarkets, regulations, tenant profiles, that's key. Work with people on the ground.
Yeah, absolutely. And maybe just a final thought to leave you with. Edmonton today seems to offer this rare combination. You've got stability, you've got potential for consistent yield, and you have access to incredibly powerful financing leverage through programs like MLI Select. Finding all those things together in today's, let's face it, pretty volatile national landscape, that's quite unique. And for investors seeking that stability, that peace of mind, it presents a really compelling opportunity worth exploring.
Excellent points. Thank you for joining us on this deep dive today. We hope this look at Edmonton's unique market conditions and these strategic financing opportunities gives you something to think about, maybe reshapes how you view real estate investment stability in Canada right now. You've been listening to AOF Market Intelligence, powered by AI.